This video discusses wearables and insurance and asks the question, where do we go from here? Actuaries, working in the pre-digital era, writing out calculations by hand, would have found it difficult to imagine today's actuary having such immense data, technology, and computing power at their disposal. Ubiquitous smartphones, advanced artificial intelligence, autonomous vehicles, the Internet of Things, drones, and blockchain are just some of the new technologies today's actuary is exposed to. The future holds even more exciting prospects with emerging fields such as quantum computing, 5G, brain-computer interfaces, smart pills, and smart dust all coming to the fore. Naturally, these changes provide immense possibilities, but also challenges and potential repercussions for the data-focused actuarial profession. As a forward-looking profession, it's imperative that actuaries must change with the times and learn to embrace the challenges and opportunities the new technology-focused digital world is creating. This video examines some of the current uses of technology within insurance with a particular focus on wearable technology. Opinions are presented on important questions that must be addressed as the use of wearables in insurance becomes more advanced and widespread. In the era of tightening data regulations and consumer concerns, a blockchain solution is proposed. This video concludes with thoughts on the important ethical considerations actuaries and other insurance stakeholders should consider to ensure we are using wearable data in an ethical and responsible way. The agenda for this video is as follows. First, we examine the emergence of insurtech. Then we discuss wearables in detail. We then look at blockchain and ask, is it part of the solution? Finally, we look at the various ethical considerations of using wearables within insurance. The emergence of insurtech. In recent years, many high-profile insurance thought leaders have argued that the industry has been lagging behind other industries, which have increasingly embedded technology throughout their business models. However, this is now beginning to change as we witness the emergence of insurtech, the use of technology innovations within insurance. Insurtech has seen many technologies coming to the fore. Here are some real-life examples. 1. Telematics. This is a technology of sending, receiving, and storing information using telecommunication devices. An example of telematics in insurance is Tesco's Black Box Insurance, which allows customers to earn bonuses for safe driving as measured via their telematics black box device. 2. Artificial intelligence. A great example here is U.S. insurtech company Lemonade. They are one of the leaders of using artificial intelligence in the insurance business. For example, they offer zero paperwork and instant everything home insurance, all powered by artificial intelligence. 3. Blockchain. This is a type of distributed database, or ledger. Insurwave is a blockchain-enabled insurance platform for marine insurance. Their platform integrates and secures the streams of disparate data sources involved in insuring shipments around the world. 4. Robotics. An example here is the global robotic process automation company, Digital Workforce. They use robotics to enable insurance companies to automate processes. 5. The Internet of Things. Neos Ventures, an insurtech company acquired by the Aviva Group, combines connected home devices and home insurance using the Internet of Things. 6. Wearable technology. John Hancock is a US-based insurer that prioritizes customers' health. One of the ways they do this is by selling interactive life insurance policies that track fitness and health data through wearable devices and smartphones. Let's now dive deeper into wearable technology. One of the key technologies to emerge over the last decade has been the Internet of Things. Our world is now saturated with a vast array of sensors that capture information across many areas, including transport, agriculture, healthcare, and property. Sensors have also made their way into wearable technologies that collect data across many aspects of an individual's lifestyle, particularly those relating to health and health-related behaviors. We have also moved beyond wrist-borne devices to now seeing wearable devices in shoes, clothing, accessories, and jewelry. This availability of more bespoke and timely data on biometrics and the ability to understand this data via machine learning is having a profound impact both on the medical profession and on patient care. The ability to detect deterioration in a biometric of choice can lead to a preventative intervention, which can be delivered at lower cost and higher efficiency than a curative response in the absence of the biometric warning. Furthermore, research from behavioral psychology and economics confirms that more immediate feedback results in a higher probability of a behavioral adjustment of an individual. The early evidence on the use of wearable technology is that it is an effective tool in changing individual attitudes, behavior, and ownership of health problems to the net benefit of the subject's health. Wearable data, therefore, provides information that can be conceivably exploited to both improve our understanding of health and mortality-related risk factors, and also used as an indirect channel to incentivize and help improve health behavior for society. Advantages of using wearable data in insurance. 1. Product innovation. The availability of these new technology-driven data metrics opens potential new avenues for health and life insurers to provide cover for previously difficult to insure or uninsurable risks. 2. Reduced adverse selection and improved underwriting and product pricing. By recording data on an individual's health behavior, the information asymmetry between the policyholder and the insurer is reduced, thus enabling an enhanced granular risk differentiation based on the true risk levels of the drivers to be achieved. 3. Enhanced customer engagement. Insurance company products do not lend themselves well to customer engagement, with most insurance buying viewed as a grudge purchase. In addition, the industry has suffered from a lack of consumer trust. The traditional insurance model, which typically involves contact at a single point in time, has arguably held the industry back in today's customer-centric world. Incorporating wearables into product design may now help to overcome this, as customers are engaged with on a more frequent basis, with the potential to reward policyholders for desirable activities. In addition, wearables data might give the insurance company an opportunity to provide policyholders with valuable health information and analysis and motivation to engage in healthier behaviors. Blockchain. Is it part of the solution? A major hurdle for insurers' ability to use wearable data relates to effectively managing policyholder concerns regarding privacy and control of data. Blockchain, as a distributed ledger technology, holds much potential for the actuarial profession. The incorporation of wearable data into insurance may also benefit from blockchain, as it potentially allows policyholders to control access to personal records and to know who has accessed them. If insurance pricing is to be based on more extensive levels of health and behavioral data, then this data needs to be shared with the insurance company, whilst allowing privacy to be maintained, as well as adequate policyholder controls and suitable security mechanisms to be put in place. Blockchain has already shown promise within healthcare in the facilitation of sharing medical data without the need to turn the data over to another party. It also, therefore, seems to have potential to be used to help manage wearable data for insurance companies of the future. Ethical considerations. With great power comes great responsibility. Wearable technology has the potential to change the insurer and insured relationship to a more continuous risk management support role, where the insurer helps to prevent adverse conditions taking place by alerting policyholders and also nudging them in the right direction. However, this shift towards predicting and preventing and influencing behavior has many potential repercussions that should be considered. To highlight this, consider the following fictional examples. 1. An insurance company rewards policyholders for activity via recording steps. As a result, the policyholder is nudged towards going for a run rather than doing yoga, even though doing yoga would be much better for the person's poor mental health. 2. A health insurer offers a policyholder a free watch with heart health monitoring capability. The policyholder willingly accepts it, as they expect the data from their rigorous fitness lifestyle to reduce their premium. The data, however, reveals a heart issue, and the insurance company ends up withdrawing cover. Let's now consider the impact wearable technology might have on insurance pricing via potential changes in insurance adverse selection. As big data continues to increase, the insurance world appears to be moving towards more individualized, granular pricing. With both increasing and more accurate data availability, it is likely that the asymmetry of information between the insurer and the policyholder will decrease in the absence of regulation. This situation will inevitably lead to a decrease in adverse selection, as the pooling of risk involves pooling lives of a more similar nature, and hence fewer lives leave the risk pool because of a pricing mismatch between risk and premium. There are many socioeconomic implications from potentially reducing adverse selection in insurance markets. The traditional view is that reduced adverse selection is advantageous and desirable, since policyholders are paying a premium closer to a statistically actuarial fair price that truly represents their level of risk. However, this traditional belief provides a good example of a situation where insurance companies and regulators may now need to reconsider traditional views, considering the new data-rich world we inhabit. For example, British actuary Guy Thomas argues that some adverse selection may actually be good for society if we consider the social value created from insurance coverage as a probabilistic loss coverage. This example helps to highlight how some groups of consumers may benefit from enhanced personalized pricing and other individuals may be potentially disadvantaged. This serves as just one example of how insurance companies, regulators, and actuaries must carefully consider the implications of incorporating new data into pricing models to help ensure that we are using data responsibly in an ethical manner. Of course, this is a key area where actuaries can potentially add value. Concluding thoughts. In an era where data is growing at an exponential rate and machines are progressively more capable of outperforming humans at many tasks, the actuarial profession, like many professions, is facing unprecedented change. Novel data sources, such as from wearable devices, combined with more sophisticated and powerful analysis, is one example of how technology is altering some areas of traditional actuarial work. As we continue to move into this new digital data-rich paradigm, new opportunities and challenges will emerge. Technology is creating a new world before our very eyes, providing actuaries with an opportunity to capitalize on our strengths of technical expertise, problem-solving ability, and professionalism to ensure we remain relevant and trusted business professionals in the future. Thank you for watching.